An overwhelming majority of institutional investors say the coronavirus outbreak is already having an impact on their investing activity, and many doubt the U.S. government's ability to effectively combat the crisis. That's according to a new survey from Eaton Partners. They say that 70% say that coronavirus, the outbreak, is having an impact on their investment activity and their 2020 planning activity. So joblessness, manufacturing and housing concerns, and extreme market volatility, that's what we're dealing with now. The question is, can sustainable assets provide long-term benefits? And what will be the role of sustainable assets, specifically fixed income assets, in recovery? Here to discuss this with us today is Ulf Erlandsson, CIO of Diem Green Credits. And today we're going to discuss the changing role of green bonds in light of the current COVID-19 crisis, the role fixed income can play in a recovery, and how investors should approach the green bonds market. Ulf, thank you so much for joining.
Thank you very much. Great to be here.
So Ulf, share with us, how has the current crisis changed the way that we look at green bonds?
I think it's very interesting from the perspective that green bonds have been a very popular asset class, and there's been a too big demand relative to supply. But suddenly with the sort of financial crisis that's come here, there's plenty of green bonds to access out there. There's plenty of interesting investing opportunities. And we also have a situation where there is this thing called additionality with green bonds. Green bonds are actually able to finance things that wouldn't get financed otherwise in this new situation that we are in, compared to, for example, just like a month and a half ago. So that's a very big and substantial change to the green bond market.
Okay, so underlying opportunities, or I should say underlying risks versus areas that investors may want to go toward right now as it relates to green bonds. What are we looking at for them in terms of risks, as well as those areas that they may want to pay more attention to right now?
So what I generally think is that you shouldn't forget that green bonds are bonds, and they have the same sort of risk on and off element that as any other bonds. However, what I think has been illustrated over the past volatility is the fact that green bonds have maybe not outperformed on the upside in some sense, but you see some of the brown bonds that are exposed to fossil risks actually underperforming quite substantially. And I think that's sometimes you have to take that perspective, that green bonds is more of an insurance versus some of the negative tail risks, rather than just making a fantastic investment in themselves. So put them in a relative stance, and it becomes quite interesting quite soon, actually.
So let's dig a little deeper into that. We're talking about the brown bonds. So let's talk about those investors who possibly were able to short, a few weeks ago, and where they were then versus where they are now. You and I talked a bit about the rating, for example, for Exxon, where it was a couple of weeks ago, and what is the expectation for them to have those types of ratings moving forward. So let's talk about brown bonds specifically, and what the risks were a couple of weeks ago, and then what the risks might be now, and what your expectations are long term.
Just a couple of weeks ago, we would see high-rated bonds such as Exxon and other of the oil majors being at the sort of the AAA or AA type of rating category. They would be tightening quite tightly, quite low spreads essentially. And there's been a very substantial move out in spreads on these bonds. I think I can even actually, on a relative sense, can almost go back to the equity market. If you look at just the equity of Exxon, for example, it's down right now. It's down 47% this year, whereas the Dow Jones index is down 32%. And there's been this correlation between not only the corona crisis, but also the OPEC and sort of the oil glut initiated by the Saudis. And this has made it like a perfect storm in terms of tail risks when it comes to some of the oil majors and the oil industry in general. And that is going to have repercussions for a long time, I think. Any risk manager in the next decade or so, looking back at the big risk that we saw out there, which was March 2020, they will also see that these type of assets actually strongly underperformed, especially in the case when you didn't want things to underperform. So the repercussions of that is going to be big. then you and I also discussed, some of the valuation impacts, and I'm fairly confident in my view that we are going into an energy transition over the next couple of decades. I really hope so for the sake of my kids. And then you look at the name like Exxon, the AAA emblem of the U.S. and global credit markets, essentially. And they have, been sliding on ratings. I think that, by the end of this year, Exxon will not have a AAA rating anymore, and I don't think they will ever actually recover that rating, given the business model they are projecting right now. So there's a certain valuation standpoint you can do in that in terms of bond valuations and bond curves, etc.
So if we're talking about looking at fixed income, and if we're looking at the major brown players when it comes to the companies that are fossil fuel, when we think about fossil fuels, we think of these companies. What can institutional investors, switching gears a bit here from fixed income, institutional investors who are looking for high dividend yields? I know we're talking about fixed income. I'm just going to, flip the script a bit and talk about equities. What can they do moving forward? I mean, do we think that these oil companies will be able to produce the same dividend yields that equity investors had known them for years, or do you see that as changing as well in the equities market?
Well, I have a specific investment hypothesis here from my side, and that's taking it from the long-short hedge fund perspective. If you look at again, a company like Exxon, I think at the current valuation, they're paying something like implied dividend yield of over 10%. And then you compare that with regards to the sort of the yields that you get or the spreads that you get if you invest on the credit side, which is pretty small compared to what you have on the dividend yield side. I mean, one thing one could argue here is, why don't you invest a small sliver in the equity side? You work the case for these companies that you actually you want them to cease with their activities. You act in a way that they actually keep paying out high dividends rather than invest it in capex. And if they run out of money, well, then you ask them to actually borrow money in the credit market. So you put on a short on the credit side and you are slightly long on the equity side. And you can start actually playing around with this in a more creative manner, I think, than just invest or divest in the traditional ESG investment style.
Okay, great. So short on the credit side and just slightly long on the equity side. That would be your solution for that.
Yeah, the dividend yield pays a lot of your costs of being short, or actually you can lever up the short side a lot, given that dividend yields are so high on the equity side. And it's essentially, making the company pay you for being short on their bonds.
Nice, great. I want to switch gears back to go back to the fixed income markets we were just talking about, but appreciate that pivot there. Very interesting. When we look at institutions, so the supranationals and the sovereign funds, where do you think their role is in terms of stepping in right now to help with the recovery?
So I think they have a very big role to play here. There's been a fair number of commitments, public and non-public, over the past year or several years from various public institutions to invest much more in green bonds. A lot of these institutions have run into a hurdle or an obstacle in the sense that there hasn't been enough supply in the green bond market. It has looked quite expensive. Now is the time when they can actually step up. And we have an example in Scandinavia, something called the Nordic Investment Bank. They committed 500 million euros to buying green bonds. By November last year, they had 130 million invested. I mean, if there is a time when they should put their money to work, it should be now. Both, I think, and that's myself as trading as a trader speaking, I think the valuations are very interesting for them to do it now. And it's also this time when the market and the issuers of this green capital, they actually need the support. So I think it's extremely important that some of these institutions step up and that they do it quickly rather than wait 6 months, because we don't know what the situation is going to look like then. The opportunity might have been missed already.
Absolutely. And taking this just a step further and talking about where the market is in context of the UN SDGs, the UN Sustainable Development Goals, what do you think the role maybe for the SDGs to play in terms of guiding us toward a recovery? Do you see that there is a role, first of all, and if so, what is that?
I think they definitely do have a huge role to play in this recovery. I don't see that, playing such a big role when it comes to straight investment activities in terms of portfolio management, etc. It's just too volatile. There's too much happening, and it's too hard to sort of nail down some of the SDG effects quantitatively into a portfolio. It's very important for investors to engage and work with the company so they actually act in a sort of a social and SDG compliant way in the recovery process. But it's not something which is directly investable. But I do think, the climate dimension is where it's actually already investable, where there is an asset class and there's a sort of good divisions between good and bad assets, and you can reallocate your portfolio right now. So on the sort of the climate related, I think it's SDG 13. It's definitely something where you can put a lot of weight right now.
Absolutely, yes. And in terms of the roadmap, if you had to give 3 top areas that institutional investors should consider for their post-crisis roadmap, what would those top 3 areas be, or those top 3 things be? And this can be in context of the fixed income markets.
So, I mean, my first takeaway is returns. This is an opportunity. I think you should be invested because it just looks quite attractive, and the green asset class will grow immensely over the next decade. So you better be ahead of that curve rather than behind it. The second part I'd like to say something about is, almost from a quantitative risk manner. What we've seen going through the markets will affect how we allocate risk and risk budgeting over a long time. So you will see certain type of assets that got hit badly to actually be much less attractive coming out of this than they were going into it. So that's a conclusion. You can start drawing that already and sort of reallocate your portfolio. Lastly, I also think, fiduciary risk used to be this sort of almost we cannot do anything but, look for risk return on a sort of 1-month rolling basis. Now we witness, the biggest tail risk since the great financial crisis. We have to start thinking about how do we implement tail risk hedges in terms of our fiduciary duty as well. It has to be part of that discussion. And I think, tail risk hedging vis-a-vis climate risk, for example, is something that should be a part of every portfolio and should be only enhanced by this greater focus on fiduciary duty in a broader sense.
So first of all, green assets growing over the next decade is your prediction, really changing how we allocate risk and looking at the assets that may be a little less attractive than they were before. And then finally, fiduciary risk, specifically tail risk hedging. Great top 3 points. Ulf, thank you so much for joining us.
My pleasure. My pleasure.
We invite you to subscribe to the Refinitiv Sustainability Perspectives podcast on iTunes, Spotify, or wherever you stream your content. What did you think about the podcast? Leave us a review on iTunes or follow us on LinkedIn and Twitter for updates on our show. Thank you for joining. See you next time.